The stock market call that I made 2 weeks ago on my podcast titled Markets Push Back the Powell Pivot is looking to be pretty prescient. I recorded that podcast on Saturday, August 20th, which followed another big Friday sell-off. And that sell-off to me looked technically weak enough that I made the call that I thought the bear market rally that began off the June lows had finally ended. A lot of people believed that the June lows were the lows and that we were in a new bull market, but I never believed that. I always assumed that what we were experiencing was a head fake. It was just a bear market rally to create a false sense of confidence, to sucker in some new longs, ultimately to pull the rug out from under them and see the market crashing to new lows. And I still believe that we are going to take out those June lows. We haven't done that yet, but it looks like we are headed in that direction. In fact, since that August 20th podcast was recorded 2 weeks ago, the Dow is off 7%, S&P about 7.2%, and the Nazdaq is down by 8.6%. So we're off to a pretty good start on taking out those lows, but we haven't done it yet. But to me, it never made sense that anybody could have believed that the bear market was already over. I mean, we were barely off 20% in the S&P. That would have been a very mild bear market, a very short-lived bear market. But it makes no sense that the bear market that we're in now would be that shallow or would be over so quickly. I think we are in the early stages of a historic bear market, both in its severity and in its longevity. Not only are we starting from an unprecedented level of excess valuation, but it's also happening at a time of unprecedented macroeconomic imbalances. The economy has never been weaker, while stocks have never been more overpriced. And we're at an inflection point because in recent history, every time the stock market was in trouble or every time the economy was in trouble, the Fed would come to the rescue with more cheap money. Well, it can't do that anymore. At least it's claiming it's not going to do that. And if it did do that, it would have dire ramifications. So for now, it's not doing it. And the markets still don't understand what this means for the economy and what it portends for stock market prices. Investors need to understand that the stock market has literally been surfing a wave of liquidity, because when we have a recession or a major stock market decline, the Fed floods the markets with liquidity. And so stock prices are floating on that sea of liquidity. The valuations are extreme, but now the Fed is pulling the plug, draining the markets of that liquidity at the time when the markets need it the most, because earnings are under pressure, because we are in a recession. This is still early. We've only been in this recession for about 8 months, but it's going to be here for a lot longer than that. But as the recession worsens, more downward pressure is going to be exerted on corporate earnings. But as interest rates are rising, the value of those diminished earnings is falling even faster because you're discounting them with a higher interest rate. But maybe more importantly, rising interest rates themselves hurt corporate earnings because corporations are carrying unprecedented amounts of debt. Now, why do corporations have so much debt? The same reason that individuals have so much debt. For the same reason government has so much debt. That's because the Federal Reserve has made it so cheap to borrow money for so long. So because of the Fed, everybody is leveraged to the hilt. The economy has never been this leveraged and never been this dependent on the cheap money that the Federal Reserve is now taking away. So we're going to go through the mother of all economic withdrawals as the Fed is weaning us from this monetary heroin. But as corporations have to pay higher interest on their debt, that reduces their earnings, because the money they give to their bondholders, they can't give to their stockholders in dividends, or they can't use that money to buy back stock.